In this continuing chronicle of a real money swing trading US stocks portfolio, my chosen trade to chat about this week is SQM, a Chile company listed on the New York Stock Exchange. I'm not even going to try to pronounce its full name. You can look it up. SQM is a recently bought position and is still open in the portfolio. In this video, I'm going to examine the process and mindset behind buying SQM in my portfolio. Warning, this scenario is different to the typical positions that are opened in this portfolio and will probably challenge most viewers, especially those who have not yet acquired the trading mindset skill of consistency, a mindset that was coached by arguably the world's best ever trading coach, Mark Douglas. He wrote a whole book on consistency called Trading in the Zone. Get it and study it. Reading it isn't enough. Let's get into today's open trade. On September 29, 2023, a mechanical swing trading entry signal occurred for SQM. That's the second last bar at bottom right of this year-long daily chart. The last bar is day of entry. I'll overlay the mechanical signals in a minute. Now, I have a well-trained eye in technical analysis and charting, built and honed over the last 33 years. But even blind Freddy can see that SQM is in a serious downtrend. However, I pulled the trigger without blinking an eyelid to buy SQM the following trading day with a market on close order, the green fingers pointing at the day of entry. Whilst an entry signal in such a pronounced downtrend seldom happens with the mechanical edge that I and my customers use, 20 odd years ago it would have been a real test for me to pull the trigger and buy in such a situation. And I can understand the analysis part of your brain struggling to understand the analysis behind this trade right now. Well, don't hold your breath for me to come up with some magic contrarian analysis, fundamental or technical. There simply is no secret price action analysis behind this entry. So why did I put my money into this trade? Put simply, because my mechanical edge signaled an entry. Seeing this chart with the previous two closed loss trades in SQM, you might be a bit more confused now. This could be the third loser in a row. I may even have triggered your emotional pain avoidance mechanism, even though it's my money and not yours. What happens when traders think about overruling their signals, or worse, actually do overrule and don't do the trade? They are associating the pattern they see right now with an event that happened in their past that looked similar to this one. An event that caused them emotional pain and despair from losing and being proven wrong. Their brain taps into that past negative feeling and gives them the perception that they know what will happen in the future with this event, and that they'll get another negative feeling of despair and disappointment. You see, the traders who think this way haven't transformed to a successful trader's mindset of thinking in probabilities. They still operate out of a societal paradigm of avoiding emotional pain at all costs. This happens automatically until they transform how they think. They measure right from wrong based on the outcome of a trade rather than on how well they follow the rules of their process. In a sentence, their beliefs are outcome-based rather than process-based. They always feel despair and disappointment when they lose, because they define losing and being wrong as getting a negative outcome from a trade. Process-based traders who follow their process to a T are always right. They have invested how they feel on what they can control, the steps and actions of their process. They define what's right and what's wrong on whether they follow their process correctly or not on the trade being a winner or a loser. You could guess a winner, or get all the analysis right and still lose, just like the analysis can look all wrong and you still get a winner. That's because every individual outcome is random, but lots of random negative and positive outcomes strung together can produce consistently positive outcomes. Put another way, lots of one-off uncertain random outcomes strung together can produce a certain outcome over the long term. That might be confusing you, and the degree to which you are confused about this statement is the degree to which you need to develop and transform your mindset to become and remain successful in the markets. Outcome-based traders place how they feel in the hands of who and what they cannot control, the market all its participants, commentators, politicians, CEOs, CFOs, and geopolitical events. These variables will always cause a lost trade that is out of your control in the next few days, weeks, or months, even with the best possible analysis in the now present moment. The outcome-based trader will blame the variable that they are not in control of and feel betrayed by that variable, which will highly energize the negative feeling they are experiencing right now when they have the lost trade, which in turn will strengthen their emotional pain avoidance mechanism and make it even harder to overcome their fears and pull the trigger on the next entry signal. Process-based traders, on the other hand, completely accept the risk of the effect of all these variables at any given time. They completely accept with every bit of who they are that all these variables are out of their control and hence never try to predict into the future, nor associate the now moment with a past event, whether it was positive or negative. They neutralize their expectations for each individual trade, but have a positive expectation over lots of random outcomes and are confident of winning in the long term because they believe in their mechanical edge and they believe in the long-term upward bias of the stock market. They have big picture perspective. They know they have to pull the trigger on every individual entry signal when they have cash available so that they can continue enforcing and energizing their correct process habit, which is being right, and not energize being wrong by breaking their process based on what they think may happen in the future. That's precisely why a consistently successful trader will take this trade in a heartbeat without question, doubt, hesitation, or reservation, without their mind tapping into what they think may happen based on past emotional pain experiences. Their thinking patterns have been transitioned to thinking differently. So where do they get their confidence from? From their belief of having an edge over lots of individual random outcomes. They think in terms of the probabilities of their edge. So what is the edge of SQM over lots of random outcomes? Firstly, let's broaden our scope to include a little more evidence. Looking at this chart going back 3.5 years rather than a year as before, you can see there were two juicy profit trades on the left of the chart of 88% and 96%. Seeing these 4 trades, 2 profit and 2 loss, will not change the mindset of a consistently successful trader a jot, but these will. So let's have a look at these results. The period that these trades occurred over is 30 years. There were 87 total trades, of which 51.72% were winners. The average profit percent per trade was 8.68%, and the average hold period was 76 days, about 11 weeks. The payoff ratio was 3.46, meaning that the average winner was 3.46 times larger than the average loser. The combination of the win rate and the payoff ratio results in an expectancy of 1.31. That is a very healthy edge, and those are the probabilities in which a consistently successful trader believes in. That is their mechanical edge. Looking at the profit and the loss trades, we can see there were 42 loss trades that had an average hold period of 38 days, and the average loss was minus 6.65%. There were 45 profit trades, that's your 51% of trades being winning trades, and the average profit was 22.99%, and the average hold period was 111 days elapsed. That includes weekends. So there you see what the payoff ratio is, 22.99 divided by 6.65. And the combination of the average loss trades being 38 days and average profit trades being 111 days ends up in the average hold period of all trades being 78 days. Let's get the up-to-date chart to the time of recording this video up on the screen. At the bottom right, you can see that SQM's price continued to fall for 5 days after entry. It has risen from that trough and is currently sitting at 5.65% open profit. Now, I have no idea where SQM's price will go from here because I do not need to know what will happen next in the market to make money. And there's a random distribution between wins and losses for every given set of variables that define an edge. Those of you who have studied Mark Douglas's book, Trading in the Zone, will have recognized these 2 quotes as being 2 of the 5 fundamental truths of trading. All the content of this video will also have made perfect sense to you. You watched all the way to the end to reaffirm your knowledge and skill of continuing to be a consistently successful trader. And those of you who didn't watch to the end, well, you'll never know. I'll check back in with you how this open trade fares as we now await its mechanical exit signal, whenever that will be. Please share this video widely if you know somebody who will learn from it. Please subscribe to this YouTube channel if you haven't already, and click the bell to get notified of future videos. Remember, past performance is not a reliable indicator of future performance. Until next time, I wish you consistent and objective investing.